Hello everyone, today's video I want to go over the stock market crash and most importantly how it could affect the Canadian stock market. Hey everyone, it's Tracy here. I'm a former engineer turned full-time investor in Canada. I manage a multi-million-dollar investment portfolio full-time. I love talking about stocks and real estate investing to create multiple streams of income, build wealth, and ultimately design my best life. Now, if you want to hear more about stock investing, real estate investing in Canada, then you definitely want to hit that subscribe button and that bell notification button to get the latest and greatest videos coming to you every single week. So let's get back to the video. Imagine we were to go back in time and we were able to pick up high quality companies like the Microsoft, the Googles, the Apples of the world back during the tech bubble crash, and then picking them up again during the financial crisis, and then buying into them again during the COVID crash. I'm sure if you held on to those stocks, you've been so happy. Now the stock market keeps plummeting day after day, especially with the tech stocks. And I have no idea if we are at all-time bottoms. But I know for sure that there are amazing opportunities and some of them are life-changing. Now I understand if you're super scared by all the news headlines, the high inflation, the supply chain disruptions, the war, etc., etc. And that's why I want to share this brief history lesson. Now there was this analysis done by Truist Advisory Services where they took and looked back at the 12 rate hike cycles in the past and how did that impact the S&P 500. Now, as you can see, out of 12 times, 11 times, the stock market actually went up during this time period. And it went up on an annualized average of 9.4% during the last 12 rate hike cycles. Now, there was one period where when interest rates were hiking, the S&P 500 stock market didn't perform so well, and that was during the 1970s. So in the early 1970s, there was the Vietnam War, there was high unemployment, there was also inflation running rampant, peaking at a year-over-year jump of 15%. They also had interest rates rising to combat inflation, which rose to double digits. So in comparison to what we're facing right now, it may seem very similar, except there's a couple things that are pretty drastically different. Our economy is not facing high unemployment. In fact, we're the exact opposite. We have labor shortages. We also have very low interest rates, relatively compared to the past 15 years. In fact, our interest rates are just jumping 0.5% every few months as per Bank of Canada, and we're just getting back to like still low interest rates. I know for sure I can't predict the future. I mean, if we could predict the future, we'd be all rich. But what I do know is that I am very optimistic about our economy, that we are reopening. We are going back to full normal. And it may be a little bit rocky over the next, 3 to 6 months to 9 months. I don't know how long it will take, but I believe that we're going to get back to normal, full normal, where every country is opened back up again, and then inflation will drop because there's not going to be any more supply chain disruptions. So I'm optimistic about our future. And frankly, I really think the government really doesn't want recession happening, because we just kind of went through one over the last 2 years where our economies were shut down. Hey everyone, I just wanted to do a brief pause and introduce you these free resources that I have from my website, Financial Nirvana Mama. If you're looking for more value plays where you get some income every single month or every single quarter from high quality Canadian stocks, then you definitely want to check out my ultimate guide to dividend growth investing, where you can actually build passive income right now. So check out in the links below, check out that guide. And if history is a good indicator of what the stock market cycles are and how they behave, I'm super confident that you will be super happy that you have these dividend growth stocks because they'll help you survive and thrive in any stock market cycle. So let's get on with the video. Now, before I jump into the Canadian stock market, I want to give you one more brief history lesson about what rising interest rates could do to different sectors. So looking at this chart, we're seeing that on average, when interest rates hike, the S&P 500 will overall drop 4% during 1 month. And then in a 1 year return, it looks like 5% average. Now, if we're going to break it down to the sectors, we're looking at -3% in technology stocks during a 1 month period, but then in a 1 year return, it's on average 19%. And these are during rate hike cycles since 1994. Now we're seeing that consumer discretionary definitely takes a hit in both 1 month and 1 year returns. While healthcare, it looks like it can, of course, take a short-term hit, but then overall annual returns is about 7%. This goes on, and I'm going to show you in this chart right here, but I want to dive into which sector is going to outperform. And probably is no surprise to you because some of you probably have energy stocks. The energy sector is going to perform really, really well. And it says it's about 15% annual returns versus a 1 month hit of average -2%, which really makes sense because in a high inflationary environment, commodity prices will go up. And then, well, those oil companies are going to probably do really, really well because the prices have gone up for them. Another thing is utilities. We have an annual return of 9%, yet there has been no hit on utilities in a 1 month period during the rate hike cycles. Now, this is a great segue on how this could impact the Canadian stock market. Now, we are so lucky in Canada that we are energy intensive. We're filled with utility companies, we are filled with financial companies, and we have relatively low exposure to tech stocks, which is why the Canadian stock market hasn't really taken a hit relative to the US stock market. But does that mean that we are in the clear in the future? I would say that if we were to look back at the past, which is what happened during the interest rate hikes, that the utilities and the energy stocks tend to outperform the market. So I would say that I'm betting that the Canadian stock market is going to be A-okay because we're filled with utilities and energy companies. But at the same time, of course, we don't know if we're going to hit recession. I honestly don't think so, but you know what? What do I know? I'm just a YouTuber that loves talking about stocks for entertainment purposes only. So I'm just going to give you my opinion. I really don't think recession is going to hit us. I do think over the next 3 to 6 months, maybe over a year, it could be very, very rocky because we don't know what will happen with the other countries. If China keeps shutting down, that's probably going to have a huge impact, a long-term impact on supply chain disruptions, which affects all of us because, well, we get a lot of things from China. We buy a lot of, stoves, appliances, batteries, etc. from China. But what if recession does hit us? Then, of course, every stock in the stock market, Canadian stocks, American stocks, every stock is going to take a huge haircut. Now, I know it's probably hard to believe because a lot of the stocks have taken 50 to 70% hits already, but that's reality. If there is a big recession, then every stock is going to take a hit. So I would say just please be courageous, have the stomach to accept the volatility of the stock market because if you look back in history, it is during these times where there are the greatest opportunities. And as the great Warren Buffett always says, be fearful when others are greedy and be greedy when others are fearful.